Okay, class, today we're going to be talking about exchange rates. So first off, it's a quote of foreign currency per unit of domestic currency or domestic currency per unit of foreign currency. So how much can be exchanged for $1 or how much can be exchanged for 1 yen. These allow us to denominate the cost or price of a good in a common currency. So here's a clipping from the Financial Times in 2013 that shows what the reporting of exchange rates quotations look like. So we have depreciation and appreciation. Depreciation is a decrease in the value of a currency relative to another. A depreciated currency is less valuable and therefore can be exchanged for a smaller amount of foreign currency. So $1 per euro turned into $1.20 per euro means that the dollar has depreciated relative to the euro, which means that the euro has appreciated relative to the dollar. So let's move on to appreciation. This is an increase in the value of currency relative to another. It's more valuable and can be exchanged for a larger amount. So we have $1 per euro turning into 90 cents per euro means that the dollar has appreciated relative to the euro. And the euro has depreciated. A depreciated currency is less valuable, which means it can buy fewer foreign produced goods that are denominated in foreign currencies. A Nissan costs 2.5 million yen times the exchange rate per yen equals $25,672.50, which means it's less expensive at a more expensive exchange rate. This means that imports are more expensive and domestically produced goods and exports are less expensive when you have a depreciated currency. Lowers the price of exports relative to the price of imports. So, on the opposite side, an appreciated currency is more valuable. It can buy more foreign produced goods that are denominated in foreign currencies. An appreciated currency means that imports are less expensive, domestically produced goods are exports are more expensive. This raises the price of exports in relative to the price of imports. Here you can say the pound or the dollar per pound exchange rates, the relative price of American jeans and British sweaters. So foreign exchange markets. These are a set of markets where foreign currencies are exchanged for domestic ones. Institutions buy and sell deposits of currencies for investment purposes. The daily volume has been estimated at around $4 trillion, which is up from $500 billion in 1989. 85% of transactions in 2010 were exchanging foreign currencies for US dollars. Most of the participants, the first is commercial banks or depository institutions. They use these for investment purposes. Non-bank financial institutions like hedge funds, security firms, insurance companies, they buy and sell foreign assets to diversify their portfolios. Nine financial businesses, they conduct foreign currency transactions so they can move their goods around and sell and buy their assets and services. And central banks conduct official international reserve transactions. Buying and selling are dominated by commercial and investment banks. Most of these interbank transactions are deposits that occur in amounts of 1 million or more per transaction. Sometimes the central bank will intervene, but the direct effects of these transactions are relatively small and transitory. Computer technology and telecommunications technology has allowed this to be a lot more rapid and more integrated markets. This integration implies that there's no significant differences in exchange rates across locations. So this kind of removes the arbitrage ability that used to exist in the foreign exchange market. So if we have a euro that's selling for $1.10 in New York and it's selling for $1.20 in London, we could buy the euros in New York and then sell them in London at a profit. So we have spot rates and forward rates. Spot rates are exchange rates for currencies exchanges on the spot or when trading is executed in the present. Forward rates are ones that are rates that will occur at a future date. So here's what the dollar per pound spot and forward exchange rates looks like graphically. Let's look at other methods of currency exchange. We have foreign exchange swaps, which are a combination of spot sale with a forward repurchase. These are done for like temporary purposes where, for example, Toyota receives $1 million from American sales, plans to use it to pay its California suppliers in 3 months, but wants to invest the money in euro bonds in the meantime. So look at other methods. We have futures contracts, which is a contract designed by a third party for a standard amount at a standard date. These are bought and sold on the market, and only the current owner is obliged to fulfill the contract. We also have options. Theirs are bought and sold in markets. This gives the owner the option, but not the obligation of buying or selling. So, what influences the demand? So, factors that influence the rate or the return on assets determine the demand of those assets. So, for example, we have the rate of return, the real rate of return, which is adjusted for inflation. Prices are fixed, inflation rate is 0, and the nominal equal the real rates. Because this occurs on a daily basis, we assume that prices do not change from day to day, which is a good assumption to make for the short run. So risk is another influence. Liquidity, which is the ease of using the asset to buy goods or services. But in foreign exchange markets, we assume risk and liquidity are essentially the same, regardless of the denomination. They're only of secondary importance. So, investors are primarily concerned about rates of return on currency deposits. These are determined by interest rates that the assets will earn, expectations about appreciation or depreciation. So, a currency deposit's interest rate is the amount of a currency that an individual or institution can earn by lending a unit of the currency for a year. So here's the interest rate on dollar and yen deposits. So suppose the interest rate on a dollar deposit is 2%. Suppose the interest rate on a euro deposit is 4%. So does a euro deposit yield a higher expected rate of return? The rate of return is simply the interest rate. The euro deposit has a lower expected rate of return. All investors should be willing to dollar deposits and none should be willing to hold euro deposits. So demand of currency deposits, this equals R in dollar terms minus R in euro terms plus E in dollar per euro terms minus E dollar per euro terms divided by E in dollar per euro terms. R's denote expected rates of returns. And the E's are expected exchange rates. The little superscript E is expected exchange rate, while big cap E's are current exchange rates. This is all under the expected rate of return on euro deposits. So if you take a look at that, so there's some models that we use. So we construct a model. This is called interest parity. This implies that deposits in all currency are equally desirable assets, and that arbitrage in foreign exchange is not possible. So this says that return on dollars equals the return on euros plus the expected exchange rate minus the current exchange rate divided by current exchange rate. So this condition should hold. Suppose it didn't, then there would be no investor would want to hold euro deposits, driving down the demand and price. So how do changes in the current exchange rate affect the expected rate of return? Depreciation of a domestic currency today lowers the expected rate of return on foreign currency deposits. When a domestic currency depreciates, the initial cost of investing in foreign currency increases, lowering the expected rate of return on foreign currency deposits. And the opposite is true for appreciation.